The 60/40 is kind of for the masses because the people who actually have money know that 60/40 is barely anything for like they've got multiple houses, they've got investing in businesses, they've got their own businesses, they've got gold, they've got speculative tech stocks. Well, I guess that goes into tech stocks, but their portfolios are probably much more than just a 60/40 stocks and bonds. Now you might say, yeah, but that's for your average Joe that doesn't understand this and that. Well, then why are you denigrating him thinking that an average Joe can't invest in a company, can't invest in their friend's business or in just a regular business, can't invest in cryptocurrency, all that sort of stuff? Buenas tardes, and welcome to episode 10 of Chainspotting, where I read and review the top stories in Bitcoin, crypto, finance, money, The Economist, The Atlantic, DL News, Coindesk, Protos, bada bing, bada boom, and all the rest of them. Today, we're going to go into the depths of the entrenched traditional media industrial complex, the kind of stuff that the majority of Bitcoiners might not read, but that I find super useful and super helpful to read. The Economist. I can hear the tweaks and turns of some of the minds of you readers or listeners. Ooh, he's going to bring out The Economist. What FUD is he going to bring on us, pull onto our table today? Actually, it's not necessarily that much FUD. We're going to be talking about diversification, something that's a topic that I find interesting and helpful and useful. But yeah, before we carry on, give us a subscribe. I would really appreciate it. It would help this channel grow a lot. It would help me do more of these. It would help improve the quality. Give us a like, give us a comment. Do you think your portfolio is diversified? Drop it below. Yes, no, why? I expect many of you are overly exposed to Bitcoin, meme coins, and shit coins. Who knows? So this is from The Economist, just staff, not a specific author or journalist that wrote this, at least unless I missed their name. Sorry about that. Why your portfolio is less diversified than you might think. The most important idea in modern finance has become maddeningly hard to implement. I appreciated that, maddeningly hard. What is the best piece of investment advice you could fit into a single short sentence? I know what you all are thinking. Buy stocks, wins point for brevity and high returns. Buy American stocks, if given at almost any point over the past few decades, would have done it even better. Don't waste money on stock pickers' fees, deserves an honorable mention. And here's a less punchy suggestion. A diversified portfolio can have the same returns as a concentrated one with less risk. Interesting. Diversification is such an important idea in modern finance that it is easy to forget its age. The economist it is most associated with is Harry Markowitz, who won a Nobel Prize for setting out its math in the 1950s. I'm wondering, Harry Markowitz, do we know if he won a Nobel Prize, an economic Nobel Prize? Yes. So for those of you that are listening in, I'd like to remind you that there is no Nobel Prize for economics. There's a commemorative prize giving out by the Swedish central bank to give out to make the economy and economists more important than they actually are. No offense to you, my saintly father who listens to this devoutedly every week, but yeah, there's nobody I find, or I found that a lot of traditional and conservative and mainstream economists aspire to the Nobel Prize for the recognition and not necessarily for the science as scientists do, which makes their theories like Eugene Fama, another Nobel Prize who just won it, was talking about Bitcoin is for sure going from, he's like, there's a nearly 100% chance that it goes to zero over the next 10 years because it would prove the monetary theory is wrong. Is there anything more vacuous, more shallow, more weak more fraught, more pitiful than a fucking economist or so-called scientist who doesn't want something to happen because it would disprove his theory. I mean, think about it. You're in the game to be able to think of theories, make new decisions, gather information, prove hypothesis, and move on, move on, move on. How lazy are you intellectually if you don't want that to happen and you just want to sit comfortable because it would prove your things wrong? Yeah, I could read say so much more about that. But anyways, but the practice, if not the theory, was popular long before that. During the first heyday of financial globalization in the early 20th century, European investors could hardly get enough of foreign assets. A survey by Charles Conant, a journalist, published in 1908, estimated that between a quarter and a half of the average British portfolio was invested abroad. In French and German portfolios, overseas allocations were around a third and a half, respectively. Such cosmopolitanism was then shattered by war, hyperinflation, capital controls, and the Depression. More than a century on, and despite present day worries of financial fragmentation, holding a varied portfolio is easier than ever. Foreign assets can be bought at the tap of a trading app, while cheap index funds give investors instant exposure to thousands of stocks in dozens of countries. The idea of diversifying across asset classes as well as geographies via the classic 60-40 portfolio of stock and bonds, for instance, is firmly in the mainstream. More exotic choices, such as commodities and cryptocurrencies, have become more accessible to retail investors too, and private assets may eventually follow suit. I've heard that the 60-40 stocks and bonds portfolio is kind of on its last legs, if not, it's always been on its last legs. Because you've got commodities, copper, gold, silver, platinum.
Here comes the money. Here we go. Money talk. Here comes the money. Money, money, money.
All that sort of stuff. Now you've got cryptocurrency. Then where does real estate fall into play? That's an interesting idea, actually. Why is a portfolio always 60-40 and you never include, or that the 60-40 is kind of for the masses, because the people who actually have money know that 60-40 is barely anything for, like, they've got multiple houses, they've got investing in businesses, they've got their own businesses, they've got gold, they've got speculative tech stocks. Well, I guess that goes into tech stocks, but their portfolios are probably much more than just a 60-40 stocks and bonds. Now you might say, yeah, but that's for your average Joe that doesn't understand this and that. Well, then why are you denigrating him, thinking that an average Joe can't invest in a company, can't invest in their friend's business or in just a regular business, can't invest in cryptocurrency, all that sort of stuff? Yeah, I've had this gripe a lot, and I will continue to have it. Unfortunately, there is a catch, and it is a big one. Building a portfolio that looks diversified has become a cinch. Building one that is actually diversified in the sense that its components offset each other's risks has become much harder. Diversification gets its magic from the fact that the prices of different assets do not all move together. The market values of a gold mine in Kazakhstan and a recruitment firm in San Francisco, for instance, will fluctuate for very different reasons if they both have similar returns. Hold shares in both, and there's a chance that a sharp drop in one will be cushioned by a rise in the other. Hold lots of uncorrelated assets, and you get this effect writ large: a portfolio with a return that is the average of its constituents, but with a lower volatility. The less correlated the asset's returns, the greater the magic. I've never understood why people are so scared of volatility. Volatility is not necessarily a bad thing. Volatility is all about life. Volatility is also a measure of the market not entirely sure on how to price your assets or on uncertainty about how to price it. That's not a bad thing per se. I know that investors are always looking for certainty, but guess what? Certainty means that the asset has found some sort of plateau and it's not going to move much more. Today, we're living in volatile times. Ooh, scared. Which means that certain asset classes and financial instruments are going to be more volatile than usual. But that's not a bad thing. People are constantly saying that Bitcoin's volatility is a bad thing. I don't think so. Bitcoin volatility is the equivalent. It exists because the market doesn't know how to price the asset. The market valuation is still small, and it's the price that you pay for being early. You have to live through the emotional distress, the financial shivering, the complete and utter shitstorm that is sometimes the cryptocurrency market, where it just falls relentlessly and then it picks back up. Well, the price of volatility, if you want the 10x, you got to be down 90%. That's just the way the market works. But people are always looking to offset their volatility. I'm okay with that. I just don't think that you should be like one of your investment goals should be trying to offset your volatility at all times. Add some volatility, you'll be fine. Yet, just as it has become easier to invest in a wide array of assets, the correlations between them have shot up. These are measured on a scale from -1 to 1. A pair of prices that always move in opposite directions, in other words, a diversifier's dream, scores -1. Prices that move in lockstep, offering no diversification benefit, score 1. In the 1970s, before the reglobalization of finance gathered pace, the average correlation between pairs of shares indices for developed markets was 0.37. By 2021, it was 0.75. So, less diversified, for those of you that are following along closely. For pairs of emerging market indices, the average correlation rose from zero point 0.05 to 0.49. As the barriers separating them have come down, markets that once moved almost independently now increasingly ebb and flow together. It's the nature of globalization, I suppose. It seems, therefore, that geographical diversification has followed a trajectory which is wearily familiar to financial historians. When few investors could manage the trick, it was a stellar idea. Once it was popular and available to the mass market, its dynamics were distorted and the benefits started to fade. A similar fate befell the Buffettian strategy of buying undervalued, quote unquote, cigar butt stocks after automated screening made them easy to identify and hence vanishingly rare. In the case of diversification, once investors started spreading their capital across stock markets, they all began to resemble each other. I guess that's like the response to mass psychology. Everybody's chasing after the same goods. I'll put the meme up here, but there's a classic meme which is on the stock market flow, which is one guy starts with the telephone and he says like buy, I think it's Apple. Buy Apple. And then it starts to pass on, pass on, pass on. There's a cartoon. And then at the end, it turns into sell Apple because everybody's following. Yeah, there's this game of telephone happening. But it's also because everybody is looking at the same patterns. Everybody is hearing the same things. There's a sort of like a retroactive feedback loop, like reinforcement where everybody is saying the same, everybody's seeing the same. It's like when I see chartists, the modern day male astrologer who sees the same pattern as everybody else who sees it, which is kind of makes it like the self-fulfilling prophecy. Now, is diversification a good thing per se? Let's finish off the article and then I'll give you what I think. What stings even more is that diversification across asset classes has become more difficult too. Between 2000 and 2021, stocks and bonds listed in America complemented each other excellently, with an average correlation of negative 0.29. Since 2022, when they both crashed together, that has risen to around 0.7. That's a big difference. There is still some benefit to spreading your portfolio across different regions and asset classes. But given the gains have shrunk so much, it is no wonder investors are chasing after ever more esoteric products. Is that a tip of the hat to the cryptocurrency space? I think it is. And I mean, it makes sense. Why would I invest in stock? I mean, okay, so there's a bunch of different ways to pick up this. Cryptocurrencies are attractive because they're easier to access, they're crypto native, or they're internet native. They give sizable more returns, even though there's a big fucking chance that you're going to lose a lot of money on the way. But the carrot in front of you looks so much more delicious than the shit that you might step in on your way to eat the carrot. there's an obvious reason why you don't want to buy stocks and you don't want to buy bonds. Like, number one, they're boring. Number two, you know that, or you there's a feeling. That's the thing. There's a feeling amongst my generation that stocks and bonds are for old people. That stocks and bonds are not really widely understood. That you're buying some sort of weird company, but you're not really. What is it? You like PNL, all that sort of stuff, and that you're just not going to make that much money. What do you invest in? Where do you invest in it? All that sort of stuff. That's why people turn to more esoteric products. Now, there's the other question of how much should you diversify? I find that it's a good idea to diversify stocks, bonds, commodities, crypto, real estate, and say businesses. I think that, remember, I'm a lonely, lowly, low life journalist. He doesn't have at all enough money to do all this sort of stuff. But that's my idea of how a successful portfolio would look like, not a 60-40 one or anything like that. And that's what a diversified portfolio would look like. You know, I'd have some in crypto, I'd have some in stocks, I'd have hopefully an apartment or some sort of real estate, maybe a nice farm somewhere in the south of Chile. Old MacDonald had a farm, E-I-E-I-O. All that sort of stuff. And then there's the question of concentration. I'd like to stop or touch on this for a second because I know Michael Saylor has talked a lot about concentrating when you find the one apex assets, which is Bitcoin, according to him. There's an argument to be made for that, but there's a big argument to be made, for example, in concentrating on your business, you know, and your business being where you reinvest everything and reinvest everything and reinvest anything. I do think that concentrating in stocks, bonds, traditional finance doesn't make sense anymore. I do think that it makes more sense if you were to concentrate on something like Bitcoin, but I think that there is arguments to be made, better, harder, sounder arguments to invest in your own business, invest in yourself, invest in your education, and then start flourishing, blossoming, and all that sort of stuff. This is a really interesting article. I really enjoyed this, and it made me think about, is your portfolio less diversified than you might think? Mine is. I have a bit of cash, a little bit of crypto, some stocks. I don't have any real estate, anything like that. Um, and yeah, it's less diversified, but because also I don't have that much money to be able to diversify broader, you know, like I just don't. I wish. And so that's also a quintessential factor that we need to put into this. We just don't have, when I say we, I say millennials and Gen X, you know, that I've been banging this drum for a while. We don't have that much money. We've lived through multiple economic crises, wage stagnation, cost of living inflation is booming, flying through the roof. So it's not that easy. Yet, I still think this is an interesting topic. I still think it's hard to be able to be diversified nowadays, especially if you're looking for those sort of uncorrelated assets. Because even today, crypto operates like a glorified tech stock, just with much higher ranges of movement and all that sort of stuff. So, yeah, that's kind of where I land and where I think. What do you think? What do you believe in? Are you diversified? Are you more diversified, less diversified? Are you all in on crypto? Are you all in on Nvidia stock, or do you own a company? Let me know below. And yeah, thanks for tuning in. I'll catch you next week. And remember, choose your news.